Before we get into today's show, we're going to listen to a great Speak Pipe voice message from Jennifer.
Yeah, Jennifer sends us something about the episode 151 with Kari Carbonaro regarding women and the great wealth transfer. Let's take a listen.
I just listened to the podcast with Kari Carbonaro. Truly impressed. It was amazing. Got me rejuvenated to seek out a new professional advisor. I fired mine about 1.5 years ago, and it seems like all men just don't want to listen. And if I put my advice in, they get frustrated. So this was such an awesome podcast. Keep up the good work. I'm catching up with FI as well, as this is my second career as a physician, but still concerned about my retirement. You guys are awesome. Love hearing your podcast. Thanks so much. Jennifer Swan.
What a great message, Jennifer. Thank you. And we want to hear from you. Leave us a voicemail on SpeakPipe. That's always in our show notes. And we'd also love for you to leave us a 5-star review on Apple or wherever you get your podcast.
Yeah, we love hearing from you. And let's get on with the show. The philosophy doesn't change. Just because you have more money doesn't mean you have to be more complicated, right?
Yeah, certainly. And to be a real nerd about it, investing is frankly just about making the numbers bigger. So if you want to make your numbers bigger, then you want to take out a smaller number from that bigger number in the form of cost. So you always want your cost to be low. I mean, that's what you should lead with when it comes to investing success, and not the sexiness of the investment. Again, alts, private equity, etc. So if you're leading with how sexy your investment is, you're probably off to a bad start.
It's really hard to be boring. And as Alan Roth says, dare to be dull. It's really hard to be dull. Set the tone with regards to alts, and everybody sort of followed into that and fell into the alt trap, as you could potentially call it, where we're seeing a sort of a payback or a squeeze these days. It's really hard to be simple. It's hard to stay that course because look what my friend's doing. It's all this comparison is the thief of joy. And we don't need to compare ourselves to others. There are very simple portfolios like you advocate in your plans that are applicable to really most people.
We have to talk about your emergency fund before we talk about your investment portfolio, because your emergency fund does impact how we're going to design your investment portfolio. Same thing for your Social Security strategy. That's going to impact how you design your investment portfolio. Same thing for how well funded you are for retirement. That's going to impact how you design your investment portfolio. A lot of folks just want to jump right into investing, and it often doesn't make sense to do so because there's other things we need to know that's going to help us better answer the investing question when we look at those other topic areas as well.
Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Hello, and welcome back to Catching Up to FI. It's a beautiful day outside. Summer is upon us. Jackie, your brother's visiting. I'm getting ready to take the dogs for a walk. But today we're inside with a guest that we've been waiting to talk to for a while. He may be a correspondent to us, for he's a certified financial planner extraordinaire that's going to tell us all about what a comprehensive financial plan looks like. And we've been talking about investor policy statements. Well, what are they? Today we're going to find out.
Yeah, exactly. Like you mentioned, my big brother, Charles Cummings, he does own a sports store, so I'll shout it out. It's Triple C Sports. It's headquartered in Aiken, South Carolina, but he is just opening up to the whole world on his website. But yeah, we've been hanging out, big brother, showing him around Ohio. We went to the Ohio State Stadium, which is pretty awesome. I don't know if you know this, Bill, but the Ohio State is the most valuable college football franchise.
No, I didn't know that, but that makes sense.
Yeah. So, hey, Ohio is known for something. But yes, I am so excited to have Jon here. We've been trying to get him on for a while. So why don't I introduce him? So Jon Luskin, he is a fee-only, advice-only certified financial planner professional and fiduciary in sunny San Diego, California. He specializes in providing hourly advice to Do-It-Yourself Investor, something we are all about, by Investment News magazine. I think he's actually younger than both of us, Bill. Jon has been featured in consumer-facing and advisor-facing publications, including the New York Times, the Wall Street Journal, and Michael Kitz's blog, Nerd's Eye View. In 2019, Jon and his wife, Lean, dedicated one full year to travel. So he's doing more than just financial planning. The two started their adventure by taking 4 months to convert a cargo van, this is so cool, into their home on wheels. They then spent several months traversing the Western United States and Mexico. Lean documented their adventure on her blog, and we will include that in the show notes. So Jon serves on the board of the John C. Bogle Center for Financial Literacy, which we all love. It is a nonprofit, and they are dedicated to helping people make better financial decisions. But not only that, in the past, Jon has provided pro bono financial planning to low-income households with the Financial Planning Association's pro bono program. And he's also done work with the San Diego Financial Literacy Center, which is also a 50C3. He has also volunteered with Second Chance Dog Rescue, Four Paws Dog Rescue, fostering rescue dogs, and as a league cycling instructor. He's also been a part of the League of American Bicyclists. Jon has taught safe cycling techniques to youth and adults and the San Diego County Bicycle Coalition. So I love someone that's doing more than just his career. So shout out to Jon. Thank you, Jon. And Jon, welcome to Catching Up to Fi.
Thank you. I appreciate it. It's surreal to hear the whole bio read. It's funny. I think about some of those projects that I used to do that are long gone now that I've got a couple young kids. I don't do too much of that stuff anymore.
Yeah, I wanted to be sure to name it because we are more than our career. And I feel like it just says a lot about you as a person, some of the things that you do outside of your daily grind. So I was very impressed with all these things that you did beyond financial planning. Right, Bill?
Well, he gives back in so many ways. And today he's giving back to our audience of late starters by educating us. But in order to understand Jon, he's not just his bio. There's got to be this little kid inside of the big kid, Jon. And there's got to be some formative years that led him to be the force in financial planning that he is today. Jon, take us back to your youth. What were the personal and financial things that happened in your life that led you to where you are today?
Gosh, wow. I guess I'd have to think about that one. I know when I was in high school, I was involved in a youth organization. I really wanted to be involved in it when I first learned about it. There wasn't a chapter in my area, so I set one up. That was fun, being president of a little chapter of kids doing all sorts of extracurricular and volunteer activities, giving back to the community, et cetera. Always been a big fan of low-cost investing because that certainly is the right way to do it. There's other ways to do it, but it's probably going to lead to worse results. So going back to the investing piece, smart investors are always going to focus on keeping our costs low.
Yeah, but so when you were a little guy, were you an investor as a young kid? Did your parents bring this about to you? Where did your interest in money take hold? I know that wasn't the case for me. I didn't get any education in it. Did you have a circuitous path, or was this always a passion of yours?
Certainly wasn't always a passion. Just going back to that altruistic streak. Well, started my career in the nonprofit sector. Again, just wanted to do the right thing. Didn't really love the nonprofit sector. And then in studying for that industry, doing my master's thesis, I decided to pivot to personal, or rather to investing and finance. So I looked at how endowments invest, and that's where my thesis was born. And that's when I learned all about, hey, index funds are investors' best bet for success. Even if you're an endowment, a university endowment with $1 billion, you can have all sorts of really sexy things in your portfolio, like private equity and hedge funds and all sorts of really attractive alts. But that doesn't matter because fees are what matter. And again, that's where I learned that keeping costs low is an investor's best bet. So that's the course that I took to get into personal finance.
Well, your thesis is interesting to me because it's apropos today. The government's made some policy changes that have really pinched some of our leading financial educational institutions because they have so much allocated to alternative investments that have an illiquidity problem. Are they coming back to this where they thought this would always be there, the government will always have our backs, but hey, lo and behold, they don't. And are we finding ourselves over allocated to alternative assets and higher education, leading to this illiquidity crunch?
Yeah, I'd say this isn't a new problem. I mean, this is a problem going back as early as the financial crisis, looking at how the endowments dealt with that. at that time. They had a lot of liquid assets, numbers were down, and they weren't able to sell those assets at that time. It was a big problem for endowments back then. Different institutions are doing different things in terms of doing more alts or less, but man, the problem of alts still remain. They're still almost certainly not the right investing solution for practically everyone.
Well, it's interesting too that the same principles that hold true for the DIY investor, little old me, can hold true and should hold true to our largest institutions. The philosophy doesn't change. Just because you have more money doesn't mean you have to be more complicated, right?
Yeah, certainly. And to be a real nerd about it, investing is frankly just about making the numbers bigger. So if you want to make your numbers bigger, then you want to take out a smaller number from that bigger number in the form of cost. So you always want your cost to be low. I mean, that's what you should lead with when it comes to investing success, and not the sexiness of the investment. Again, alts, private equity, etc. So if you're leading with how sexy your investment is, you're probably off to a bad start.
I know a lot of these big endowments, they pay to have their assets professionally managed, right? And that, of course, add to the fees. Do you work with any endowments? These are billions of dollars that could be managed. Now, we know as little do-it-yourselfers, yeah, passive indexing works, but even if you add some zeros, it's the same thing. Do you work with any of these? Because I think they think they're doing the right thing, but
yeah, it's difficult to comment on whether they think they're doing the right thing or not. I mean, if you really want to geek out on it, there is some career risk involved. If you were to be managing an endowment portfolio and say, hey, let's go with all index funds, because at that point, what are you paying the manager for if they're telling you just to invest in index funds? And then if all the other endowments are also doing alts, you don't necessarily want to be the one outlier saying, hey, let's do something different. There's also conflicts of interest. The hedge fund manager is on the board of the endowment. He makes a contribution to the school, and then the school invests in his fund. So there's some non-investment return focused reasons why these institutions may be investing in anything but low-cost index funds. There are a handful of some small institutions that I do advise with insofar as how to invest. And of course, it's always going to be, hey, let's use ultra-low funds to invest. That is your best bet for investing success.
yeah, and for the boards that I serve on, usually I will be on the investment committee or something like that. And I'm definitely always advocating for simple index funds and giving them obviously research and things to sort of back it up. But we will include that in the show notes because it's fascinating what you did your thesis on. To me, it's a very relatable thing that possibly could help out endowments and some of the other, I guess, organizations that you talk about. So kudos for that.
It's really hard to be boring. And as Alan Roth says, dare to be dull. It's really hard to be dull. It set the tone with regards to alts, and everybody sort of followed into that and fell into the alt trap, as you could potentially call it, where we're seeing a sort of a payback or a squeeze these days. It's really hard to be simple. It's hard to stay that course because look what my friend's doing. It's all this comparison is the thief of joy. And we don't need to compare ourselves to others. There are very simple portfolios like you advocate in your plans that are applicable to really most people.
Yeah, I think most people either read the wrong parts of Swenson's book or read the parts where he said, hey, don't do this, and then blacked out and then decided to go into alts and everything else. If you read Swenson's book, Swenson, the guy who ushered in the popularity of alts into endowments, he talks a lot about the difficulty and the process you have to go through to be successful in these areas. I think a lot of folks miss that because that's the boring part, right? Instead, it's all about, hey, I can brag about the hedge fund that I'm investing in because it certainly sounds cool.
Well, before we dive into what does a comprehensive financial plan and an investor policy statement look like, I've got to hear about this year of alternative or alt living that you did where you rehabbed a van on your own with your wife and tooled around the country. Are you a house hater? Because you wrote a blog post, don't buy a house, take a sabbatical instead. And people don't do this. What drove you to be a house hater, a van lover, living the van life?
I think he's setting a trap. He's setting a trap, John.
I wouldn't really say I'm a house hater so much as I don't think folks are thoughtful enough about the pros and cons of home ownership. When we went on our little adventure, we sold our home and that funded our sabbatical and also some rental property investments later down the line. But that's a whole nother story. Man, the sabbatical was an adventure. I wouldn't recommend building a van. I certainly learned a lot. I learned all about creating a whole electrical system, solar, and having the vehicle engine, charge up the coach battery and AC and DC and generators and all that stuff. It was a very challenging project, but gosh, it certainly was a lot of work. We initially planned to do it for 1 month for the build, and it stretched into 4. If you've never done before, what you're doing, and you want it to be at least reasonably comfortable and enjoyable, you're going to spend a lot of time on it. Yeah, and then we traveled for several months in the US. We were planning to do more than just Mexico. We were planning on doing some Central America, but COVID hit right when we had got to the tail end, the southern end of Mexico. And so our travel pretty much stopped there at that point because of all the shutdowns.
This is not something that people think of doing. Where did you get this wild hair? This is countercultural to what the U.S. is like. Get your house, your picket fence, grow your kids, stay at your job, by and large, up until recently for 30 or 40 years. And you are leading the wave on how to think differently. What helped you think differently about housing and adventure early in life, as opposed to buckling down and becoming the next 31, 32-year-old retiree?
I wouldn't say necessarily did it early, at least relatively. For us, it was our last big hurrah before kids. So, hey, we're going to have kids. Before we do it, let's do the thing that we can't do when we do have kids. So that was the idea behind the travel, and it worked out pretty well. So now we got a couple young kids and can't do really much of anything else at all right now, short of swim classes and taking them to birthday parties and whatever you need to keep a couple little young human beings alive. So it definitely did work out well because we got to scratch that itch, if you will.
We live that life for sure. So you got the kids now. And your wife, she documented this. So it's memorialized. For those that want to hear about Jon's adventures, about the van life and all that, we'll include her blog posts in the show notes because I found them kind of cool. Now, one other thing in your intro, I mentioned that you sit on the board of the Bogle Center nonprofit, and there's a really cool thing that they're doing right now. Can you just briefly talk to us about that?
Yeah, so Jon C. Bogle Center for Financial Literacy, we have all sorts of resources for do-it-yourself investors where they can learn about investing at low cost successfully for themselves. We have an annual conference that we do every year. I know you guys have participated in the past. I know you're coming back for more, so I hope that speaks to how great the conference is. Tickets are on sale now. By the way, boglecenter.net to check that out. To answer your question, Jackie, recent initiative we're doing, Jonathan Clement's Getting Savings Going initiative. Jon Clement's prolific writer on personal finance. He's got a new book out. That's a compilation of all his best writings, and proceeds are going to help jumpstart the investing savings of low-income youth. So it's a special side project that the Bogle Center is involved in. Let's figure out, hey, what happens if we give $1,000 to low-income earners to put into a Roth IRA to invest? So little new side project initiative that the Bogle Center is involved. Oh, actually, maybe not little, rather big project that the Bogle Center is involved in. At the conference every year, we have 2 tracks. We have a retiree track and a track for younger folks. Whether you're saving for retirement or whether you're close to retirement, we've got a track for you. We've got content for you at the annual conference.
Yeah, Bill and I are both pretty impressed with that. As soon as I heard about it, I immediately made a donation. Bill made a donation. And so we definitely want to support that for any of our listeners. The Bogleheads Center provides a ton of financial literacy and education. Even at the conference, if you can't make the conference, they record all of the talks and offer them completely for free on YouTube. So if you want to support that, we'll include that in the show notes. One of my favorite charities. And I do love going to the conference. Now, did you mention the date of the conference? It's in October?
Yeah, October 17th through 19th this year, San Antonio, Texas at the Hyatt. And then for folks who did want to contribute to the center, boglecenter.net/donate.
And this year, Jackie's speaking at it, so all the more reason to go and see your hostess with the mostest talk about FI and FIRE for a generational change in what the Bogleheads were. It's now no longer all these older people with gray hair. There's a bunch of youth and sons and daughters. It's having a generational turnover, and we invite you to join us at this conference. Bogleheads are diehards originally, and one of the things that is pivotal in a Boglehead's life is sort of this comprehensive financial review, and ultimately boils down to, in the investing piece, an investor policy statement. Your day job is hourly advice for DIY investors, and you asked the question, is one day financial review for you? I've looked at on your website several of these financial reviews, and they're quite comprehensive, and they have similarities that run through them with the individual differences that the people come to you with questions that they have. Can you just give us a 10,000-foot view of what this one-day financial review is and what are the categories of things that you like to go through with people to help them get their financial lives sorted? What is this global financial review look like? Because it can be overwhelming. How do we break this down? What are the things that you like to look at when they come to you wanting this one-day review? What are the kind of the items that you need to go through in order to understand their financial lives and help them?
I'll answer that question in the order that I usually cover it with folks, as that's what's burned into my memory. So we look at a lot of topic areas. And one thing that I always stress to folks is that you kind of need to do that because some topic areas, which you might not even believe, impact other topic areas. That's to say, we have to talk about your emergency fund before we talk about your investment portfolio, because your emergency fund does impact how we're going to design your investment portfolio. Same thing for your Social Security strategy. That's going to impact how you design your investment portfolio. Same thing for how well funded you are for retirement. That's going to impact how you design your investment portfolio. A lot of folks just want to jump right into investing, and it often doesn't make sense to do so because there's other things we need to know that's going to help us better answer the investing question when we look at those other topic areas as well. So already mentioned in the order that I cover them with folks, financial basics, that's going to be emergency fund. And that's going to be if you're tracking your spending, how you're tracking it, and accurate at that or not. And then Social Security, what your strategy is there. Then retirement planning, how well funded you are. From there, I looked at insurance coverage for folks if we still have a while to go until we're funded for retirement. And we'll know that because we'll already have done retirement planning at that point. Then we want to talk about disability insurance. And then if you have dependents on you that need your income, then life insurance, and then long-term care insurance as well might be something that can be a fit for someone. And that'll know the answer to that after we've done the retirement planning exercise. That's to say, hey, if your retirement plan looks really, really good and you've got more money than you can possibly ever spend, then at that point we know, hey, we probably don't need a long-term care insurance, for example. And then the opposite is the case. Hey, if your retirement plan is looking pretty shallowly funded, then long-term care insurance might be a product that can help manage some risk for you. For example, umbrella insurance, that's a big thing most folks miss. And then to round it off, property and casualty coverage, optimizing our auto insurance, our homeowners insurance, etc. From there, I tackle estate planning with folks, and this is a huge thing that most folks miss. I'll get folks who want to talk about bond duration, but then they'll have a kid, a minor child, and not have a will, right? So, hey, let's make sure we do our estate planning. So the will, it's almost certainly going to make sense if you have minor children. Same thing for a trust. And then I can't think of a situation where someone wouldn't want a financial power of attorney and an advanced healthcare directive or some sort of proxy for healthcare. Those are formal estate planning documents that you work with your estate attorney to create. Likely, unless you use an off-the-shelf offering, which might be a solution for some folks who have really simple situations. And then to round out, we'll have an emergency letter. So an emergency letter is an informal resource. This isn't something we need an estate planner. This is going to be a resource you're going to create for your trusted parties and your family. Hey, when I die or when I have cognitive impairment, here's where all my accounts are. Here's how to access them. Here's the trusted parties I'd work with, my estate attorney, my tax preparer, their contact information, etc. And so that's estate planning. And then having done all that, now we can talk about investing. Hey, let's keep the investing piece as simple as possible because I've already given you a ton of homework to do in the area of estate planning and insurance, perhaps your financial basics as well, right? Showing up that emergency fund, maybe tracking your spending if you haven't done that already. And then time permitting on these 2-hour phone calls that I have with folks, then we'll do some tax planning after that, some tax planning opportunities. Maybe that means doing a backdoor Roth IRA contribution. Maybe that means taking advantage of a mega backdoor Roth 401k contribution, a workplace retirement plan, for example, maybe using an HSA. Jackie, I know you know all about that.
Yeah, that's my thing.
So that's usually where I round it out. I always hesitate to say the work I do with folks is comprehensive because there's a lot of stuff I don't cover, as I shared with you in an email beforehand, Bill. And that's going to be, I don't do any sort of student loan planning. That's not in my area of expertise. Any private equity compensation, also out of my area of expertise. Cross-border finance, don't know too much about that, right? So if you're trying to move money from India to here or back, as some examples of folks that I've had conversation with before, I'm not a good resource for that either. So hesitate to use the word comprehensive for that reason, because there's a lot of stuff that I just don't cover, but I certainly do try to cover as much as possible, especially because a lot of areas impact other areas. Again, so much impacts how you're going to invest, et cetera.
Yeah, John, and I think you made a great point just at the end there. For anyone that is looking to work for a financial planner, make sure that the planner focuses on your area of specialty. For instance, student loans. There's a student loan planner who is a partner with the show. I'll make sure the link is in the show notes. They do planning around your student loans. That's what they specialize in. John, to me, I would call it comprehensive because it hits almost all the different areas of personal finance. And it doesn't just talk about investing. It doesn't just talk about taxes. It's a whole bunch. Obviously, there's a lot there. What I really appreciate, and I do not see this very often, but on your website, you have sample financial reviews. And they're usually, 7, 8 pages or something like that. Got beautiful visuals and everything. Let me just mention a few profiles that you have on there. Now, Bill, I pulled one of them for you because it reminded me of you. It was something about a physician, but one of the examples is dual income, do-it-yourself investor household with the majority breadwinner retiring this year. A mid-career, 7-figure income household, a business owner, and long-time do-it-yourself investor. So we'll include a link to these, but everything John just mentioned, he has provided a very nice, clean sample that do-it-yourselfers can reference if you really want to start putting this together for yourself or have a sense of the things that you should be looking at, even if you want to work with a professional like John.
Well, I mean, there's a lot that you threw out there, and there may be a couple of things that we should touch on because it's important to track your spending and have a good rainy day fund. But then you get into some of the tax planning stuff, and you mentioned backdoor Roth IRA, mega backdoor Roth IRA, HSA. Just give us a brief snippet of what a backdoor Roth IRA is. Others may want to hear about what a mega backdoor Roth IRA is as well.
Sure. Backdoor Roth IRA contribution, it's a way for high earners to make a Roth contribution. So there's phase out limits, which is just a nerdy way of saying if you make too much money, tax code says you can't contribute to a Roth IRA directly. But you still contribute to a Roth IRA indirectly with a backdoor Roth IRA contribution. And I think here's a great opportunity for me to preface, not tax advice for educational purposes only. Speak with your investment professional before making any decisions. What you can do is you can make a contribution to a traditional IRA and then just immediately convert that contribution to a Roth IRA because there's no contribution limits on a traditional IRA. Now, there's certainly phase outs of deductions, but that doesn't necessarily apply anyway for a backdoor Roth IRA contribution. We're not going to take the deduction anyway. But one thing to bear in mind when making a backdoor Roth IRA contribution is, and here we're getting a little more geeky, you don't want to have any tax deferred dollars in any other IRA. So SEP IRA, traditional IRA, rollover IRA, simple IRA. If you have money in those accounts, when making a backdoor Roth IRA contribution, it's going to create a tax bill. So what's the solution for this? If you can, you want to move those dollars into a traditional workplace retirement plan if that workplace retirement plan accepts transfers and has low fees. And normally you can almost only do this if you're still working with that employer. So if you got an old 401k somewhere, you almost certainly can't make that transfer. So hopefully that answer wasn't too complicated, but in short, backdoor Roth IRA contribution, it's a tax strategy where high earners can get more money growing tax-free.
Yeah, I think just another blind spot. I hear a lot of people talking about backdoor Roths, but they forget about this whole pro rata rule and things that you just explained. So another reason to work with a professional or do some additional research if you decide you want to do some of these things yourself. There's all these gotchas because we know how the IRS works. I never even thought about that whole pro rata rule that you just explained until like a couple of years ago. But thank you for explaining that. We've got the guy here. So
And then you also mentioned, and I know this is a complicated finance 201 type thing, and you have some great visuals in your sample financial plans, but we keep hearing this term mega backdoor IRA. This doesn't apply to necessarily all people because it's plan specific, but can you basically give us the 10,000 foot view of what a mega backdoor Roth IRA is?
I'd say one clarifying point is I would call it a mega backdoor Roth 401k, not necessarily a mega backdoor Roth IRA. So mega backdoor Roth 401k is either your workplace retirement plan, or maybe if you're self-employed like myself and you've set up your own individual 401k to have the following feature, is that there are contribution limits on how much you can put into a workplace retirement plan, such as a 401k. So it's going to be $23,500, I believe, for 25. It goes up with inflation each year. And then you have a catch-up contribution of $7,500 if you're over age of 50. So that's the most you can put into a workplace retirement plan, right? Whatever 401k you might have with your employer, as called an employee deferral. Now, then your employer, they can put in an amount as well. Maybe it'll be $0, maybe it'll be a fixed amount, maybe it'll be a match, maybe it'll be a percent, but they can make a contribution as well. And they can do that up to, I want to say it's $46,500 for this year. Again, the numbers go up every year, so forgive me if I don't have the exact figure memorized, but I do have it written down. And so that gives you an all-in-one contribution limit of what's going to be $70,000 for 2025. So you could get up to $70,000 into your workplace retirement plan for the year if your workplace plan allows additional contributions that go by many names. These additional contributions can be called after tax, they can be called non-deductible, they can be called voluntary after tax, they can be called post-tax, but it's a way you, besides your employer and besides the employee deferral of $23,500, a way you can get more money into that plan. And so if your plan offers this feature, then you can get up to 70 grand, not including the catch-up contribution, into your workplace retirement plan each year. And that's big money, right? That's 70 grand. That's going to be a lot more than just that 23,500. This is something I do for my own individual 401k for self-employed folks, right? I can put 70 grand into my individual 401k because it allows those after-tax contributions. Now, to keep going a little more geeky, on the tax code, once you make those after-tax contributions, you don't necessarily want to let them just sit there as after-tax contributions, because if they just sit there and they grow, then the growth on those after-tax contributions becomes taxable. It creates tax-deferred dollars. And so ideally what you do is you take those after-tax contributions, which you never took a deduction for because they are after tax, and then you convert them to Roth. And now all those dollars grow tax-free, right? So imagine making a $70,000 contribution into your 401k and it grows tax-free for your entire life. So a pretty appealing strategy. It's pretty complicated. Again, if you're self-employed, you can set this up on your own individual 401k with a little bit more work. The off-the-shelf offerings, the prototype plans that you get over at Schwab or Fidelity, they're not going to have this baked into what you can get with them directly. You'll have to use a third party to add these additional features, to add the after-tax contribution feature and the in-plan Roth conversion feature to your individual 401k. So that's if you're self-employed. But if you're working at a really big company with a really sophisticated 401k, they're going to have this feature, right? So big tech companies have this. Facebook, Google, Apple, they already have this feature in their 401k. If you got a little mom and pop dentist operation with their 401k run by John Hancock, probably not. You're almost certainly not going to have this feature in there. That's not to say you can go to your boss and be like, hey, boss, I found a way that you can save a lot more money into our workplace 401k. I have worked with folks in the past in setting these sort of features up with their workplace 401k plan. There was a dermatology practice. They had a simple IRA, had high fees, had lower contribution limits. So we worked together. We went to Vanguard. We set up a workplace 401k that had these after-tax contribution features as well as in-plan Roth conversion features. So now employees can save a lot more money in that plan and at lower cost too.
So obviously that is a great maneuver for high income earners that still want to get some tax benefits. Now, I was a modest income earner, 80,000-ish or whatever before I retired, so I couldn't exactly do 70,000. However, I'm the consummate, curious, do-it-yourselfer. So there's a couple years where I did do that mega backdoor Roth. I was with a company, it wasn't the Google or the Facebook, but it was a pretty big company that's in the S&P 500, and they did allow it. If you're a high income earner, you're wanting to try to get more into those tax advantage accounts, this is ideal for you. You just have to go to your employer for the 401k or whatever and see if they offer that. But that is tremendous, something I had never heard of before. But when I heard about it, I'm like, you know what? I'm going to see if it works for my company. I only got a couple $1,000s in there, whatever, but it does work. And my company did offer it. Great maneuver for higher income earners.
So other terms that you mentioned there that I think are important for our audience to understand more granularly are something like tax loss harvesting and tax gain harvesting that you talk about in your tax strategies. Can you take us through briefly what each of those is to pique the interest of our audience to dig deeper?
First, I'll say the sample plans on my site are a little bit old. So one, they don't necessarily reflect all of my current updated philosophies when it comes to personal finance, investing, tax planning, etc. And then also my current write-ups are a lot longer. Depending on how much folks want to read, they can bear that in mind. tax loss harvesting, it's possibly a double-edged sword. So I'm not as bullish on tax loss harvesting as when I initially wrote those write-ups. Yes, you can save some taxes today, but that might be creating a larger lifetime tax bill for you in the future. It's going to depend on your circumstance. Now, if you've got more money than you're possibly ever going to spend and your heirs going to inherit it, and there's going to be no future tax law changes, and that's just silly and impossible to know, then maybe tax loss harvesting can make sense. It's going to allow you to save some taxes today that will never have to be repaid back. But if you're possibly going to be spending that money later in the future, I would think twice about tax loss harvesting today, because yes, you save some taxes today, but as I mentioned, you might pay those taxes back later. And moreover, you might even pay them back at a higher tax rate. Taxes right now are, if your long-term capital gain taxes are effectively on sale relative to recent history. So I would be very thoughtful about doing tax loss harvesting today. Michael Kitces wrote a really great post about this. Perhaps we can have you guys link to it in the show notes, talking about think twice about doing tax loss harvesting. Tax gain harvesting is the opposite. If we're in a low tax bracket, maybe it makes sense to increase our basis, because that can help save us on some taxes in the future. I'm going to sell this position today at a gain, but the gain is not going to be taxable because I'm in such a low tax bracket. That's going to be the case when looking at your federal taxes, but you want to bear in mind state taxes too. So if you're in a state that does have state income taxes, I would also be thoughtful about doing tax gain harvesting today. But if you're in a state where there are no state income taxes, that certainly makes it a stronger case for tax gain harvesting if you're in a lower tax bracket today and you expect to need this money in the future. Hopefully that was helpful.
Yeah, can you, just for our audience too, take us through a little bit of the mechanics, because there are some specific mechanics. It sounds sexy, tax loss harvesting, but there are specific mechanics that you have to go through in order to harvest the loss. Can you just take us through the process that people have to watch out for?
It's rather complicated, which is certainly another reason why you don't necessarily want to jump into it, as maybe we'll talk about later. I've got a huge bias for especially investing simplicity. So tax loss harvesting is, I've got an investment, I bought it at $100, market's down, now the investment is valued at 90, right? So I can sell it at 90 today. Hey, now I've got a $10 loss on my taxes. That's going to help save me taxes on my annual tax bill. But now the problem is you got $90 in cash. You no longer have investment exposure. So you need to reinvest that 90. You need to buy investments again. Now, if you buy pretty much the same investment, IRS says, no, you can't do that. And so now you don't have the ability to write off that loss. It's called the wash sale rule, if you want to be a real nerd about it. So how do you get around this wash sale rule? And again, not tax advice, for educational purposes only. Speak with your tax professional before making any decisions. Is you want to buy an investment that's not substantially identical. So if I've got VTSAX, for example, Vanguard's low cost broad market index fund, I'll sell that and then I'll buy IXUS instead, another low cost broad market index fund. I'm sorry, IXUS, that's the international variety. Let's do iShares Total US. I've got the mutual, there we go, ITOT, right? There's a ticker for that one. So this is going to maintain my investment exposure, but I still get to have my tax loss. Now, the catch is, now my basis is $10 lower. Right now it's 90 instead of 100. So if I ever sell it at 100 when I need cash, now I've got that $10 gain. And if I'm in a higher tax bracket when I do that, then tax loss harvesting would have been a bad decision. So it can get pretty tricky pretty quickly. The other thing you want to bear in mind is that if you're still earning, if we're not yet retired and we're still investing and saving regularly, that means that we're regularly buying VTSAX, for example. So if we're selling VTSAX from one share of it, and then our automated investing program is buying it the next day, boom, we've just triggered the wash sale rule. So if you're making ongoing contributions, tax loss harvesting gets even more complicated. You've got to find other funds to invest in, because the wash sale rule can extend as much as 60 days from the date of sale. So pretty complicated strategy. Cody Garrett frames it pretty well. Return on hassle, right? Is the juice worth the squeeze on this one? I would say probably not. A lot of the do-it-yourselfers I work with really enjoy the nitty-gritty and the investing minutia and really try to optimize as much as possible. And that's why they might be interested in a lot of these things, as much as I try and sometimes talk them out of it, encouraging them to keep it simpler.
Yeah, and those are just brokerage accounts. So if you have 401k, retirement accounts, wash sale rule, tax law, none of that matters for tax advantage retirement account. So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. Our social media maven is Diana Falk, and our editor is Fritz Brizard. We love them, and they keep us going.
Yeah, Jackie, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community, and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptofi.com and check out our vetted resources, partners, and affiliates for discounts and their services, because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to Fi. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to Fi. Cheers.